Last week, I built a strategy that beats buy and hold in a backtest. Great returns. It still would have never gotten me a single payout because a funded account isn't one test, it's two. Evaluation and then funded. And my strategy was trying to do both jobs at once, which means it was actually built for neither. That might sound like a technicality, but it's not. It's the difference between passing an evaluation and actually getting paid. So today, I'm splitting it into two separate strategies, one for evaluation and one for funded. I'm attempting this as someone who has no coding background and zero professional experience trading. If I don't fix this, I don't get paid. Last week I built out these three strategies for different regimes. They were curated specifically to perform well in different market conditions. Each one had a different market condition where it performed best. I then upgraded those strategies for profitability, adding different features instead of optimizing existing parameters. After backtesting the results, I created a regime switch to automatically deploy the best one given the market conditions. After testing over multiple years, here's what I noticed. The master strategy that deployed one of the three at any given time had the highest average returns and the second highest profit factor. But there was a catch. If I deployed this in a funded account, I would never get a payout. A funded account has two completely different stages, evaluation and funded. This strategy was trying to do both of those jobs and failing at both. So this week, I split that strategy into one optimized for evaluation and one optimized for the funded stage. Because if I keep treating these two stages as the same, I'll never get a payout. In my current situation, I have one master strategy that deploys one of three regime-based strategies. What I'm changing to is two master strategies that each deploy one of two regime-based strategies, one for the evaluation stage of a prop firm and one for the funded stage of a prop firm. So how am I building these regime switch indicators for the eval and funded strategies that determine which strategy within that master strategy gets deployed? Let me show you. Essentially, what it involves is scoring each of the two strategies within the given master strategies and assigning each of them a score. And then simply, whichever score is higher, that's which strategy is deployed. With the eval regime switch, a lot of that score is based on which is most likely to break out and have a big move. And with the funded switch, a lot of that score is based on which has low volatility and low variance. Now, order of operations. How are we actually going to implement this? As we know, it's broken down into two sections, the eval stage and the funded stage. The first step involves creating the base of the evaluation strategy and the funded strategy. So combining both of the individual strategies in each one of those stage strategies and then adding the switch of when to deploy which one. And doing that again for the eval stage and the funded stage strategy. Next, for the eval strategy, we want to tweak the risk profile and optimize for the highest probability of passing the evaluation stage. And then for the funded strategy, we want to tweak and optimize for the highest probability of securing a payout. They're very different environments, so this is where they're really going to differentiate from each other. So what do those different environments actually look like? Here we have a top step 50K funded account, the rules I'll be using for this simulation. On the left, you can see the evaluation rules, and on the right, the funded rules. Feel free to pause and take a look at them. Now, let's actually implement what we've been talking about. First, the evaluation strategy. So first attempt, after coding the strategy and trying to backtest, not a single trade was placed. And this is because of the notional margin trap. The top step funded account allows you to open 5 contracts during this stage. However, the notional value of 5 contracts on ES is close to $1.25 million. So this 50K initial capital, TradingView is going to view it as impossible to purchase even one contract. However, after fixing this issue and adjusting how TradingView viewed the max drawdown, we were able to get the strategy to start placing some trades. And now here's the perfect example of how you can have a good strategy, but if it isn't optimized for prop firms, you will just never get a payout. Over the past year, we can see the returns on this strategy were 18.5%. That is not bad at all. In fact, it actually even beat out a buy and hold. However, we need to look at all of this volatility. That would never survive the drawdown limits of an actual prop firm. Because what we need to do is gain $3,000 profit before going into $2,000 of drawdown. And although this strategy has an incredibly high profit, the drawdown is just way too much. If we look here at this net P&L column of the trades, we can see, okay, plus 2,000 plus 2,000, that is above 3,000, but due to the consistency rule that wouldn't even pass the eval, and then blow the account. Here, maybe would have passed the eval once, but you really would have had to dilute for that consistency rule. And then blown account, add it together, blown account. This strategy is about a 50-50 win rate that is just way too low for our purposes, and although it's very profitable, it will just never work on a prop firm and we'd never get a payout. So, what's the good news? Well, we accidentally built a very profitable strategy. But the bad news is the win rate is way too low to pass evaluation stages. So, went back to the lab, tweaked some of the code, and optimized for a higher win rate, with the trade-off being lower profits. Now, contrary to what might seem normal, this strategy is 10 times better. And it all has to do with this shape. Consistent slowly up, sharp down. Consistent slowly up, sharp down. Consistent slowly up, sharp down. It relies on a key component that we can exploit of evaluation stages. Losses can be catastrophic. Say this is your equity curve in an evaluation stage. And this is your max drawdown. Whether your next trade brings you here to negative $2,001 or infinitely down to negative $1 million, you pay the same price. You blow the account and have to reset it, and it's say $85 to reset the account. Whether in the simulation you lose $2,000 or $1 million, you pay $85 to reset. That is the aspect that we're looking to exploit here. We can get our win rate really high by allowing our few losses to be catastrophic, because we don't have to feel the pain of that catastrophic loss. I'm going to show a video here of the trades in chronological order of the backtest. And from what we can see, obviously we've seen before, it's not profitable, because when we do lose, the losses are huge. However, the strategy barely loses. The win rate is super high. And so yes, you are going to blow accounts occasionally. And when you do, they're going to be blown horrifically, but not very often. Now let's move on to the funded strategy. So after mashing together the code, the two individual strategies of the tweaked volatility version for the funded account stage and the mean reversion strategy, and then adding in the regime indicator switch on top of that deploys one of those given strategies, the results out of the box were very good. We saw a high number of trades, which is what we're looking for due to the consistency rule, and then decent profit, nothing crazy, but that's because the main thing we're looking for is this super small drawdown, and that curve is very smooth up and to the right. So what was good about it? We had low drawdowns, a lot of trades, and decent profits. So what needs improvement? Well, for now, nothing. There were certain parameters that I could optimize to up the profit, but it would really just be overfitting to the sample data. There was no actual mechanics that jumped out to me immediately that would need to be improved. And I will revisit this before it's deployed to check again if there's things that I can optimize. But for now, it's at a good point, and it does its job. So now the fun part, testing both. Would these actually get us payouts? So again, just going to flash the rules up. You can look at the specifics if you want. And then below, again, you can pause to see the specifics if you want. What it is a list of the assumptions that I had to make to do this analysis. So what dates were we backtesting over? I chose a 3-year period. I thought that was a pretty substantial amount of data from 2023 to 2026. Here we can see the evaluation. Again, it's crazy looking at this equity curve that this is good and that this is actually what we want, but it is. Because again, like this huge drawdown, well, that's in like 2 trades. That's blowing 2 accounts. So you pay the reset fee twice maybe. And then here, the funded strategy over the 3 years, what we're looking for, smooth, up and to the right. The non-ideal is there is a pretty substantial section here at the beginning where it is pretty much just flat. Not going to be getting a lot of payouts during that period. So how did I do this analysis? I downloaded both of the lists of trades from the backtests as CSV files. Now what that gave me is thousands and thousands of trades. I was not about to comb through that by hand, so I just had Claude do it. And the reason I mention that is there may be some errors. There shouldn't be any major mistakes. Just wanted to throw that caveat in there. So here are the results. 27 payouts, $48,000. 172 resets, $14,000. Net profit over 3 years, $33,000. If that number seems low to you, like wow, you could make that much in 3 years working a minimum wage job, part-time, keep in mind, this is one account. So this would be if you never scaled up over those 3 years. You saw you were profitable and were just like, nah, I'm just going to keep doing one account. I'm not going to scale, which obviously you wouldn't do. If you're profitable, you'd scale up. The biggest thing that surprised me here, 20% pass rate on the eval. From what we were looking at in that screen recording earlier of the trade history from the eval strategy over the backtest, I would expect this to be 60 or 70%, if not higher. So I'm very confused what's going on here. That I will likely have to look into in the future. There's a chance that maybe I was just looking at a really good section when I actually did go into the data by hand and look at it. That could always be the case, but it does seem really low. The strategy had an 80% win rate. It would only take 3 winning trades to pass the eval, given the 50% consistency rule. On average, 80%, you're winning 4 out of 5 trades. I don't know, it seems low. And then the other thing is, again, how mentally hard this would be, because you're getting 27 payouts, which is less than 1 a month, but you have to reset like 5 times in a month. And so if you have the full conviction, the trust that it is going to work, obviously it wouldn't be much mental stress, because you'd be, okay, I know the probabilities, I'm just paying these reset fees, and then once I get the payout, it's going to cover them and more. But just sending that money out the door and not seeing anything for a month may be a little difficult. But it also depends. Like, if you're making good money, $400 of expenses a month might not be anything. Like, yeah, as we can see here, only half of the months you're actually getting a payout. On 3 out of 4 funded accounts, not getting a payout. But this is the part that I think can be drastically optimized, because most of the cost is coming from failed eval attempts. And again, I just do not think the eval pass rate should be that low, given our strategy. It just doesn't make sense. So I'd say that's probably going to be the biggest focus for next week, is figuring out why that happened and trying to fix it. So this page is just reinforcing the idea that, again, you got to trust the process, that one payout does cover all those expenses, because 42%, even once you pass the eval and get funded, are blown before the first payout, which actually isn't that high if the eval pass rate was as high as it should be, but it's not, so that does start to become an issue. So that was the results of my simulation, and how understanding that asymmetric risk in the evaluation stage can turn you from 0 payouts to profitable. Next week, I'm going to try to figure out why that eval pass rate on the analysis of the data was so low. Was that a problem with Claude on the analysis, or was it really just that low? As always, thank you for listening. This was purely a journal, definitely not advice, and I'm in no way a professional.